In the field of corporate finance, every firm is separated into markets. That's the first, product, and the second one is capital. Every firm is operated in the two primary markets, the product market and the capital market. The firm can make money in either market. Any of one can be made, and the most people understand that the firm's role in the product market to produce and sell those goods and services at a price above the cost. In contrast, the role of the firm in the capital market is less, and it can be well understood by every people in the market. In the lesson of corporate finance, to raise and invest the fund to directly facilitate these activities in the product market. When the people think about the capital market, they typically focus on the security exchanges for those that stocks, bonds, and other options. However, this is only the supply side of the capital market. The other side is comprised the user of capitals, the firm themselves. The crucial lessons, very important lesson that when doing a corporate finance is the strategy, which is called a financial or corporate strategy, and the product market strategy needs to be consistent with specific target, goal oriented, and it's linked with one another. It's interdependent policy. In addition, corporate finance span both the product market through its investment decisions and the capital market through its financial decisions. When thinking about the corporate finance, a firm must determine its product market goals. Then only the product market goals are set. Management sets in its financial strategy and determines its financial policies. Policies include in the financial sector like the capital structure decision, the level of the debt financing and the term structure of debt, the amount of secured and unsecured debt, whether the debt will have a fixed or the floating rates. It's attached to the debt for the amount anything will have to pay as a dividend, and the amount of timing for the equity that issues and the stock repurchases also can be done. It's a process of so on. It can continue likewise. And the investment policy to build or acquire, the restructuring or a tender. It also can be a merger, etc. Anything, leverage, buyout, everything can fit in a concert with the firm product market strategy. It is critical for a firm, very important, to have a good product market strategy. Its financial operation can also clearly add or destroy the value it is created through the exploitation of a market imperfection in one of those three important markets. The first one is the product market imperfection that include the entry barriers, cost advantages, and the patent. The next, the capital market imperfections that involve the financing at below market rates, using those innovative security model, reaching those new investing clients, etc. policies. And the third one is the managerial market imperfection that include the agency cost, the cost from the separation of ownership and the control, and the manager who are not doing a good job, or the self-dealing processes. Those are the important exploitation that discussed for the value that is created to the market. Without the market infrastructure, there really is no corporate finance basically exist. The main important areas, if you summarize those factors, that the basic tools and the techniques of the corporate finance and what they actually mean, how to apply, how to implement, and it's all about tackling and ratio and working capital management also used as a diagnosis as well as in the development of those income statement and the balance sheet, the backbone of the market valuation estimation. It's not possible to do the valuation without being able to do the pro formas, how to generate those estimated cash flows and how to estimate the appropriate discount rate to convert the cash flow into the net present value. That's the main techniques and tools. Apart from that, it's also a cash flow management sector, which is essentially how to ensure the firm does not run out of the cash. Lack of cash is a fund shortage, you can say. The fund shortage and the cash flow run out of the business is a critical scenario for the business to be maintained or for a growth sector. Cash flow management is basically necessary to evaluate the financial health of the firm, forecast the financing needs and the value assets. The tools that used in the cash flow management include the ratio analysis, the pro forma statement and the sources and the use of those funds, the managing and forecasting the cash flows, and examined in the next step to how the firm make those good financial decisions. That is how a firm should choose its capital structure and the trade-off of the various financial alternatives. The financial policies and their impact on the cost of capital. The firm can create those values with their choice of financing. And one type of financing is maybe superior to the another should the firm use those debt or equity. If the firm use those debt, if it uses, they should be obtained from a bank or from the capital market. Should it be a short-term or a long-term debt, convertible, callable. If the firm issues those equity, should it be common stock or the preferred stock? All these scenarios can be raised. A questions asked in every business owner's mind or any market evaluator can estimate those how the firm can make those good investment decisions and the tools and the techniques to value those investment projects that will be covered, including the determination of relevant cash flows and the appropriate discount rate. The main techniques to value anything that can be which we covered, that the real options, the fifth method, and the knowledge of options, and the book will and those different way to value the firm and the project will the main families or the techniques. For the example, the cash flow techniques include those weighted average cost of capital and the cash flow of the firm, economic value added, free cash flows to the equity discounted and the cost of equity, as well as calculating the adjusted present values. They create those value using some link with the investment strategy in the product market, financial strategies in the capital market, and the corporate strategy for the setting those corporate goals. The consistency is linked with all of these strategies like corporate investment and the financials for the capital market. All those makes the consistency with create those values and the investment policies, and along with consistency is made linked with those financial policies like dividend, capital structure, maturity ladder, security choice, secured or unsecured risk management, ratios, pre-funding, repurchases. All those financial policies make those valuation in the consistency of the execution of the investment and the financial execution. And those investment execution leverage it for the tender and the financial execution, minimize those costs, security design and issue for the transforming the schematic of those corporate finances. That's all for now. Thanks for watching. I hope this information will be useful. See you in the next video.